We've all heard about the recent retirement boom, and we can add something else to the discussion now, the word transitory. This week, U.S. Federal Reserve Chairman Jerome Powell officially put the word transitory into retirement, moving away from using that term to characterize inflation. Consequently, he also signaled that the Fed may move faster on the tapering of bond purchases, ending the quantitative easing program potentially far sooner than the mid-2022 expectation. This Powell pivot, as it's being called, has led many investors to pull forward expectations for rate hikes. There are more than 2 hikes now priced into 2022, and it's driven shorter-dated Treasury yields up significantly and led to a flattening of the yield curve as longer-dated yields have fallen. So is the inflation genie out of the bottle, and will the Fed get more aggressive on policy changes? Let's break it down. First, and importantly, we agree with Fed Chair Powell. Inflation has been more persistent than we had thought, and the longer that trend has continued, the less meaningful the word transitory has become. The U.S. economic reopening is best characterized by fits and starts. It was heavily influenced late summer and fall by the rise in the Delta variant, which exacerbated some of those supply constraints that have impacted prices. Now, as we heard from corporate America during the recent quarterly earnings calls, companies have been able to, for the most part, pass these price increases on to consumers. At least so far, this has not impacted demand, which remains extremely robust. Add to that the significant increase in energy costs and the rise in housing expenses, prices, and rents, and the ingredients for higher inflation have certainly all been there. We've started to see evidence, though, that inflation may peak soon. Recent data from ISM indicates that delivery times are improving for U.S. manufacturers. This has led to an alleviation of some of the pricing pressures that we've seen from supply constraints and logistical issues. We've seen shipping costs, for example, fall significantly and fewer aging containers sitting in our ports waiting to be unloaded. This is good news. At the same time, we've seen a material decline in the price of many commodities. Oil and gas, for example, are both down 20% from recent highs. We've seen market-based inflation expectations falling as a result and significantly off the peak levels. Now, a few notes of caution. We continue to see upward pressure on housing prices, and with a heavy weighting in inflation benchmarks, we anticipate that these higher prices may continue to provide upward pressure on inflation. Further, the more persistent upward pressure on wages may also offset some of the benefits of falling prices elsewhere. And of course, the ultimate note of caution is the discovery of the new Omicron variant and the concern that it may provide a headwind to growth and a tailwind to inflation, as it has the potential to put further pressure on labor and other supply constraints. So our view here is that it's early days. We're going to learn a lot more over the coming weeks, but we're confident that the economy and companies will continue to be resilient, as we've all learned from experience how to manage. So lots of uncertainty, and the risk case remains that inflation continues to surprise on the upside. Our base case, though, is that the inflation genie is not out of the bottle, and that we'll see an inflation moderation in 2022. However, we agree with Chairman Powell and think a faster taper is wise in the face of this uncertainty. Getting past the tapering of QE gives the Fed the flexibility to move sooner if they need to, if inflation is not moderating. We still think market expectations of a few rate hikes in 2022 are too high. We have our first rate hike penciled in for late 2022 or early 2023. But having options open and being able to react quickly to the risk case makes a lot of sense right now.